127 million barrels rerouted, not destroyed, not lost, repriced. Oil drops. Headlines scream peace. And yet, silver spikes. That's not normal. That's not how markets are supposed to behave. And if you're only watching headlines, you're missing what's actually happening underneath. Because right now, at this exact moment, we are not seeing the end of a crisis. We're watching the setup for the next phase. And this phase is where the biggest money gets made. Welcome back to John Forecast, where we decode the macro forces behind the gold, silver, and global market moves. Now here's the part almost nobody is asking if this is peace. Why are metals rising? Why did silver jump from around 72 levels back toward the mid to high 70R range in days? Why didn't it collapse like it should have? And more importantly, why are central banks still buying gold even after de-escalation? That's the puzzle. And once you see the answer, you don't just understand silver, you understand how money actually moves. Let's move fast, because this isn't about storytelling anymore. This is about positioning. Here's what just happened. A ceasefire announcement hits the market. Oil drops sharply after trading above 110 per barrel during peak tension. Stocks bounce. The dollar weakens slightly. Everything looks like a textbook risk-on reaction, but then gold rises. Silver rises even faster, and suddenly the narrative breaks. But here's where it gets interesting. This isn't the first time markets have done this. In fact, this exact pattern has repeated in every major geopolitical cycle over the last 50 years. Initial relief, followed by repositioning, and then the real move begins. Let me explain in one simple line: markets don't move on headlines. They move on expectations of what comes next. And right now, the biggest players in the world are not buying the peace story. They're positioning for what comes after it. Because this ceasefire is not resolution, it's delay. Now think about this. A temporary pause in conflict doesn't outfix the energy supply instability, the inflation pressure from commodities, a global debt expansion, a currency devaluation risks, a central bank distrust of fiat systems. None of that disappears. Not in 2 weeks, not even in 2 years. So what happens instead? The market recalibrates. And this is where silver enters the picture. Because silver is not just reacting to fear, it's reacting to a structural shift. Now let's zoom out, because if you only look at today's price, you miss the entire story. 1 year ago, silver was trading roughly in the 30-35 range. Then it surged, breaking past 50.07 LO, and at one point in early 2026, it touched levels above 120 per ounce. That's not a normal move, that's a repricing event. And then came the correction from U120 down to U70, a sharp, violent drop. And that's where most people made the mistake. They saw the drop and assumed the move was over. But here's the reality: that drop wasn't the end. It was a reset. And this is critical because every major bull market in silver follows the same structure. Phase 1 in gold moves first, phase 20C silver lags, phase 30C silver explodes. We are entering phase 3. But wait, here's where it gets weird. Even after that massive run, silver is still undervalued relative to gold. And this is where the gold to silver ratio becomes powerful. Historically, it takes around 40-60 ounces of silver to buy 1 ounce of gold. Right now, we're still hovering above that range. That means one thing: silver hasn't fully caught up yet. And when it does, it doesn't move slowly. It moves violently. Now here's a simple way to visualize it. If gold holds strong at elevated levels, and the ratio compresses, silver doesn't just rise, it accelerates. And this is exactly what institutional investors are watching right now. But here's the part most people completely miss. This isn't just about metals anymore. Silver has transformed. It's no longer just a monetary asset. It's now a critical industrial metal. And this changes everything, because demand is no longer optional, it's structural. Let's break that down quickly. Solar panels require silver. Electric vehicles require silver. AI infrastructure, yes, even that, requires silver in circuit systems. And this demand is not slowing down, it's accelerating. Global solar expansion alone is consuming a massive portion of annual silver supply. Now add EVs, add electronics, add data centers, and suddenly you have a demand curve that keeps rising while supply struggles to keep up. And this is where things get serious. Because silver supply is not easily scalable. Most silver isn't mined directly. It's produced as a byproduct of other metals, so even if demand surges, production doesn't immediately respond. That creates pressure, and pressure in commodity markets always resolves in one way: price. Now pause for a second, because this is where the entire story shifts. This isn't about a ceasefire. This isn't about short-term volatility. This is about a structural imbalance that has been building for years, and the market is just beginning to reflect it. Now here's a question for you. If silver demand is rising, supply is constrained, and macro conditions are unstable, why would prices go down long term? They wouldn't. And that's exactly why smart money is positioning now. Not after confirmation, not after headlines, before the move. Because here's the brutal truth about markets: by the time something feels safe, the opportunity is already gone. Now if you think that's the full story, it's not. Because what's happening behind the scenes right now is even bigger than supply and demand. We're seeing a shift in how the world stores value. Central banks are accumulating gold, reducing reliance on fiat reserves, diversifying away from dollar exposure, and when gold moves in that environment, silver follows. But with more volatility, more speed, and much bigger upside, and this is where the idea of a 30x move comes into conversation. Now let's be clear, that doesn't mean silver goes up 30 times overnight, it means relative performance against other assets. Because if silver begins to outperform equities, especially in a weakening economic cycle, the relative gain can be massive, and we've seen this before. During previous cycles, silver didn't just rise, it exploded. Short bursts, violent rallies, massive percentage moves in very short timeframes, and those moves didn't happen when everything looked perfect. They happened when things looked uncertain, just like now. Now here's the part most people still don't understand. This entire setup is happening quietly, no mainstream panic, no massive headlines, no widespread retail participation. And that's exactly what makes it powerful, because the biggest moves in markets start when nobody is paying attention. So let me ask you, are you watching price or are you watching positioning? Because those are two very different things. And the investors who understand this difference are the ones who move early, before the breakout, before the narrative shifts, before everyone else arrives. Now, if you think silver is moving because of retail investors, you're already behind. Because retail doesn't move markets. Liquidity does. Institutional flows do. Policy shifts do. And right now, those three forces are starting to align. But here's where it gets strange. At the same time oil surged above $100, inflation expectations jumped, something unexpected happened. Bond yields started falling. That shouldn't happen. In a normal world, higher oil, higher inflation, higher yields. But that's not what we're seeing. So what's going on? This is the signal, the quiet one, the one almost nobody is paying attention to, because when yields fall during an inflation shock, the bond market is telling you something critical. This isn't just inflation. This is recession risk, and that changes everything. Because once recession risk takes over, the Federal Reserve has a problem. Actually, an impossible problem. They can't keep rates high because the economy starts breaking. They can't cut aggressively because inflation isn't fully under control. So what do? They panic. Not publicly. Not on press conferences, but through policy, through liquidity, through quiet interventions. And this moment, this exact shift, is what institutional investors are positioning for right now. Because historically, this is where the biggest moves begin. Let me explain the mechanism. Every major crisis over the last 50 years follows a pattern: shock, a panic, a policy response, a set repricing. We are between phase 2 and phase 3, and phase 3 is where silver moves. But here's the key. The move doesn't start when the Fed announces it. It starts before. Because markets run policy. And that's exactly what we're starting to see now. Let's break it down. When recession risk rises, the market begins pricing in rate cuts, even before the Fed confirms it. And when rate cuts come into expectation, real yields drop. And when real yields drop, precious metals rise. This is not theory. This is one of the most consistent relationships in macro markets. Now combine that with something even bigger, global liquidity cycles. Because while everyone is focused on the Fed, liquidity is expanding elsewhere. Central banks around the world are easing, injecting capital, supporting their economies, and that liquidity doesn't stay contained. It flows into assets, into commodities, into metals. And when that liquidity meets a supply-constrained asset like silver, you don't get slow moves, you get spikes. Now here's where it gets even more interesting, because institutional money is not buying what already moved. They're buying what's lagging, but about to catch up, and silver fits that perfectly. Gold already had its run, it broke out, it established dominance. Silver, still volatile, still misunderstood, still underallocated. That's where opportunity lies, and this is exactly how institutions think. They don't chase headlines, they rotate capital from crowded trades into asymmetric ones. And right now, silver is becoming that asymmetric trade. But here's the part most people still don't understand. This next move won't be smooth. It will be chaotic, sharp rallies, sudden drops, fake breakouts. Because silver doesn't move like gold, it overreacts. And that's why most people miss it. They get shaken out before the real move begins. Now pause. Because this is important. The biggest risk in this market is not being wrong. It's being early and not being able to hold. Because volatility forces decisions. And most of those decisions are made at the worst possible time. This is why institutional investors focus on structure, not price. Because structure tells you what's happening. Price just tells you what already happened. Now let's talk about the real trigger. Because everything we've discussed so far leads to one moment. The moment where policy shifts from tight to supportive. That's the ignition point, and it doesn't require a full rate cut cycle. Sometimes just the expectation is enough. A slight change in language, a softer tone, a hint of concern about growth. That's all it takes. because markets don't wait for confirmation. They anticipate it, and when that anticipation hits a market like silver, already constrained on supply, already supported by demand, already positioned by institutions, the move becomes explosive. Now let's layer in one more factor. The US dollar, because this is where the macro picture connects. When the dollar weakens, commodities rise. Not because they change, but because the measuring unit changes. And right now, we're starting to see pressure build on the dollar, debt levels rising, confidence shifting, global diversification accelerating, and when that trend continues, silver benefits mechanically. Now combine everything: a falling yields, a rising recession risk, the policy pressure on the Fed, a global liquidity expansion, a weakening dollar, structural supply deficit, industrial demand surge. That's not one driver. That's convergence. And convergence is what creates exponential moves. Now here's where we climb the escalation ladder, because up until now, this has been important. Now it becomes serious, because if this setup plays out fully, we're not talking about a normal commodity cycle. We're talking about a repricing of real assets against financial assets, a shift in capital allocation from paper to physical, from speculation to scarcity. And in that environment, silver doesn't just rise, it revalues. And this is where the idea of extreme upside scenarios comes in, not as hype, but as possibility under the right conditions. Because if silver starts outperforming equities while liquidity shifts and macro pressure builds, relative gains can become massive. And this has happened before. Not once, multiple times, but every time the same thing happens. 95% of people miss it. Not because they're uninformed, but because they're focused on the wrong signals. They watch headlines. They watch daily price. They wait for confirmation. And by the time confirmation arrives, the move is already gone. Now here's the final hook before we close, because there's one piece most people still don't see. Even if the ceasefire holds, even if tensions ease, even if markets stabilize, this setup doesn't disappear. It slows, but it doesn't reverse. Because the forces driving it are bigger than one event. They're systemic, and systemic shifts don't unwind quickly. They play out over years. Which means this isn't just a trade. It's a cycle. And cycles reward those who understand structure, not noise. So here's the real question. Are you reacting to headlines? Or are you positioning for what comes next? Because those are two completely different mindsets. And only one of them builds real advantage. Most people watch price. Smart investors watch movement. Most people wait for clarity. Smart investors act on structure. Most people see volatility as risk. Smart investors see it as positioning opportunity. And right now, whether you realize it or not, you're standing at the edge of a major shift. Not guaranteed, not risk-free, but real. And the difference between those who benefit from it and those who watch it happen will come down to one thing: understanding. Now I want to hear from you. Do you think this is the start of a major silver breakout or just another temporary move before a pullback? Because that conversation is where real insight begins.